Looking at Learning Unit 2, for Learning Unit 2, they say we need to go through chapters 2 to 4 of the prescribed book. So we need to go through chapters 2 to 4 of the prescribed book. And in chapter 2, we're going to look at the overview of financial institutions, and we're also going to look at the different financial institutions, which is basically the banks. And then we're also going to look at the, when you look at the banks, you're going to be looking at the commercial banks, the investment banks, and also the issues of conflict of interest and risks in what? In banking as well. So that's basically what we're going to be looking at in chapter 2 as part of Learning Unit 2, and that's what we need to cover today. So looking at banks, they say on paragraph number 2, today, most large banks engage in both commercial and investment banking. Commercial banking involves, among other things, the deposit taking and lending activities we have just mentioned. Investment banking is concerned with the assisting companies in raising debt and equity and providing advice on mergers and acquisitions, major corporate restructuring, and other corporate finance decisions. So large banks are also often involved in securities trading as well. So commercial banking can be classified as retail banking or wholesale banking. So retail banking, as its name implies, involves taking relatively small deposits from private individuals or small businesses and making relatively small loans to them. So wholesale banking involves the provision of banking services to medium and large corporate clients, fund managers, and other financial institutions. So both loans and deposits are much larger in wholesale banking than retail banking. And so sometimes banks fund their lending by borrowing in the financial markets themselves. So typically, the spread between the cost of funds and the lending rate is smaller for wholesale banking than retail banking. So please take note of this as potential theory questions as well. So however, this tends to be offset by lower costs as well. Now, looking at commercial banking, they say commercial banking is in virtually all countries has been subject to a great deal of regulation. So this is because most national governments consider it important that individuals and companies have confidence in the banking system. So among the issues addressed by regulation is the capital that banks must keep, the activities that are allowed that they are allowed to engage in, deposit insurance, and the extent to which mergers and foreign ownership are allowed as well. So they give us the bank concentration in the US. We don't need to worry much about the historical implications there. Then they give us a summary balance sheet of an assumed bank as well. And when you look at the summary balance sheet of an assumed bank, remember this is your accounting equation. Your assets is equals to equity plus liabilities. And what do we see on the assets of the bank? These are the income generating assets of the bank, where we say we have the cash, we have the marketable securities, we have loans. Then we also have those what are non-income generating assets, like for example, fixed assets as well. Then we have liabilities and net worth, where with liabilities, this is where you find your deposits, your subordinated long-term debt, and then the net worth in this case would be the equity capital of the bank as well. And if you look at the financing of the 100 million that is being financed there, the equity capital of the bank is about 5 million of the 100 million that is being financed as well. And majority of the money is basically coming from deposits. So this relationship is the reason why you see that there's high regulation when it comes to commercial banks as well, mainly because they are utilizing people's money, and in most cases, the depositors are not that informed when it comes to the investments of the bank as well. So looking at unit 2.2, we look at capital requirements of a small commercial bank. Remember, the small commercial bank that we're discussing here is the one that we are saying that is an assumed commercial bank, which is given by this balance sheet on table 2.2. So based on this, they say, to illustrate the role of capital in banking, we consider a hypothetical small community bank named Deposits and Loans Corporation, in short, DLC. So DLC is primarily engaged in traditional banking activities of taking deposits and making loans. So a summary balance sheet of DLC at the end of 2018 is shown on table 2.2, and a summary income statement for 2018 is given on table 2.3, which is the table below there. So if you look at table 2.3, what do we see? The interest income is 3, loan losses is 0.8, non-interest income is 0.9, non-interest expense is 2.5. So this gives us a pre-tax operating income for this bank, which is equal to 0.6. So here they say, table 2.2 shows that the bank has 100 million in assets. So the bank has 100 million in assets. And if you check on the asset table there, the 100 million in assets is basically what they're showing us is the breakdown of these assets, which is equal to 100 million. And then they say, most of the assets are loans made by the bank to private individuals and small corporations. So if you look at here, about 8% of the assets of the bank is basically, which is 80 million in this case, is basically loans to private individuals and small corporations. And then the cash and marketable securities account for 15% of the assets. So cash is 5%, marketable securities 10%, which is 10 million. So cash and marketable security in total is equals to 15 million, which is 15% of the total assets. Then they also say the remaining 5% of the asset is fixed assets, which is basically the building, equipment, or etc. So a total 90% of the funding for the bank of the assets comes from deposits of one sort or another from the bank's customers. So when you're now looking at the funding of the bank, what do we see? 90% is coming from deposits, and then 5% is coming from long-term debt, subordinated long-term debt, and the other 5% is the one that's coming from what? From equity there. So based on this, that's why you see that they're saying here, a further 5% is financed by subordinated long-term debt, and the remaining 5% is financed by the bank shareholders in the form of what? Equity capital. So the equity capital consists of the original cash investment of the shareholders and earnings retained in the bank. So consider next the income statement for 2018 is shown in table 2.3, which is this table. And here they say the first item on the income statement is the net interest income. And here they say this is the excess of the interest earned over the interest paid, and it is equals to 3% of the total assets in our example. So it's 3 million. So our total assets equals to 100 million. So that's why they say it's 3% of the total asset, because it's 3 over 100. So it is important for the bank to be managed so that the interest income remains roughly constant regardless of the movements in interest rates in different maturities. So we will discuss this further in chapter 9. So here they say the next item is loan losses. So this is 0.8% because it's 0.8 million, and of total assets for the year in question. Clearly, it is very important for management to quantify credit risks and manage them carefully. But however carefully a bank assesses the financial health of its clients before making a loan, it is inevitable that some borrowers will end up defaulting. So this is what leads to loan losses. So it's basically coming from the default from customers. Then they say the percentage of loans that default will tend to fluctuate from year to year with economic conditions. As we have seen, when the economy goes through an expansionary phase, the defaults are lower. And when the economy goes through a recessionary phase, we're expecting what? The defaults to be higher as well. So here they say, It is likely that in some years, default rates will be quite low, while others, they will be quite high as well. The next item, non-interest income, consists of income from all the activities of the bank other than lending money. So this includes fees for services to the bank for the services the bank provides for its clients. And in the case of DLC, non-interest income is 0.9% of assets because it's 0.9 million. Then the final item is non-interest expense and is 2.5% of all assets in our example. So this consists of all expenses other than the interest paid. So it includes salaries, technology-related costs, and other overheads. So as in the case of all large businesses, these have a tendency to increase over time unless they are managed carefully. So banks must try to avoid large losses from litigation, business disruption, employee fraud, and so on. So the risk associated with these types of losses is known as operational risk and will be discussed in chapter 23, which we're not going to be discussing. We're not going to be covering this. So is there any question when it comes to the breakdown of the statement of comprehensive income and the statement of financial position for this assumed bank? Any questions? All right, can you take a few minutes break until 15:25? Can we take a few minutes break until 15:25? Then at 15:25, we look at capital adequacy. So can you take a few minutes break until 15:25? Then at 15:25, we look at section 2.2.1, which looks at capital adequacy. Can we continue? So we are now looking at section 2.2.1, where we're looking at capital adequacy. So when you look at capital adequacy, we're trying to find out whether, remember we said our assets is equals to equity plus liabilities. So we're basically saying that when you look at capital adequacy, we're trying to check to see if the equity available is enough to cater for the losses that we may encounter from the what? From our assets. In case we suffer losses from our assets, do we have enough equity to cater for these losses? Why? Because at the end of the day, we need to try as much as possible to protect the depositors. So because we're trying to protect the depositors, we need to make sure that we have enough equity available to cover the potential losses in case we suffer losses on our what? On our assets as well. Because if we don't want a situation where the depositors are expecting their money and then they end up getting less than what they deposited in their bank accounts as well. So with that in mind, we look at on section 2.2.1, they say one measure of the performance of the bank is return on equity. And here they say tables 2.2 and 2.3 show that DLC's before tax return on equity is 0.6 over 5. So in this case, the before tax return on equity is given as before tax return on equity is given as your earnings before tax divided by the value of equity. Then if you multiply that by 100, it will give you the before tax return on what? On equity. So based on this, if you check on the information that they give us, you will see that on the assumed example, our profitability, our pre-tax operating income is 0.6, and the value for equity in this case is equals to 5 million. So the value for equity is 5 million. The pre-tax before return on the pre-tax operating income is equals to 0.6. So that's why you see that way they say the pre-tax before the before tax return on equity is 0.6 over 5, and 0.6 over 5, it would mean your pre-tax return on equity is going to be equal to 12%, because you're now going to say 0.6 over 5 multiplied by 100. So it's going to be your pre-tax before tax return on equity, which is your pre-tax operating income is 0.6 million, and your equity is equals to 5 million. And if you multiply that by 100, you see that your before tax return on equity would be equal to 12%. So this is how they're getting the 12% before tax return on equity there. Are we on the same page so far? Any questions? Now, moving on. So here they say, if this is considered unsatisfactory, so if the 12% return is considered unsatisfactory, one way DLC might consider improving its return on equity is by buying back its shares and replacing them with deposits so that the equity financing is lower and the return on equity is higher. For example, if it moved to the balance sheet table 2.4, where equity is reduced to 1% of the assets and deposits equals to 95% of the asset, then the before tax return on equity will jump to 60%. So here, if you look at this table 2.4, remember our deposits initially were, if you check on our initial balance sheet, our deposits were 90 million and our equity was equal to 5 million. So if we increase deposits here and use that money to pay back or to buy back some of the equity. So if we increase deposits and use that money to buy back equity, it would mean how we are going to be able to, it means that the balance sheet is going to be something like this, where the deposits are now going to be increasing to 94 million. So which means the extra 4 million is being used to buy back equity as well, which means that equity now becomes what? 1 million, which gives you the 100 million. So based on this, remember we saw that the before tax, the earnings before tax was equal to 0.6 million. So which means the 0.6 million divided by the value of equity, which is equal to 1 million, it would mean our before tax return on equity would jump to 60%. Are we on the same page, or now we're getting the 60% return in this case? Any questions there? Anyone lost? Now, so the question would be, what does that mean? So there is an incentive for the bank to have less equity and more deposits, isn't it? Which is basically leverage, because deposits is basically debt, isn't it, to the bank. So there's an incentive for them to do that, because if they do that, it means that during the good years and the company is profitable, they're able to generate a profit of what? 0.6 million. They're able to increase what? The return to the shareholders' wealth, isn't it? So now they say, so how much equity capital does DOC need? The question can be answered by hypothesizing an extremely adverse scenario and considering whether the bank would survive. So suppose that there is a severe recession, and as a result, the bank's loan losses rises by 3.2% of assets, by 3.2% of assets to 4% next year. So if they rise to 4%, now we need to find out exactly. So what happens to the pre-tax operating profit as well? So here it would mean remember the loan losses initially was 0.8%. Now they're going to be 4%. So it would mean we are going to be having net interest income of 3 million. Our loan losses are now going to be equal to 4 million, because they're increasing by 3.2 million from 0.8 million. They're increasing by 3.2 million to 4 million. And then our non-interest income is remaining the same at 0.9. And our non-interest expense is equal to 2.5 million. So given this information, how much would be our pre-tax operating income? How much should we get there? So how much would be our pre-tax operating income?
Reynolds is going to be a loss of 2.6.
So it's going to be a pre-tax operating loss. So in this case, we're going to be having operating loss of 2.6. Is it? So we're going to be having an operating loss of 2.6 million, right? So which means now if it's a pre-tax operating loss of 2.6 million, let's assume that our taxes are equal to 30%. So if our taxes are equal to 30%, how much is going to be the taxes? How much is going to be the taxes? How much is going to be the taxes? It will be 0.78, isn't it? When you suffer a loss, SARS reimburse you for that, isn't it? So we have a what? A tax benefit in this case. So it means our after tax. So our after tax loss is going to be equal to how much? How much will be our after tax loss?
One 1.82.
So our after tax loss will now be equal to 1.82 million. So our after tax loss is going to be equal to 1.82 million. So that's basically what they're trying to demonstrate. So that's what they're trying to demonstrate when you look at this information here. So this is why they say this will result in an after tax loss of about 1.8% of the asset. It's about 1.8% of the asset because our after tax loss, if it's 1.82, as a percentage of our assets, is going to be 1.82 over 100, which gives you 1.8% of the assets. Are we on the same page? Any questions? Anyone lost? So on page 30, they go on and say, in table 2.2, equity capital is 5% of assets. So an after tax loss equal to 1.8%, although not at all welcome, could be absorbed, right? So if our after tax loss is equal to 1.8% of assets and our equity capital is 5%, it would, although not welcome, it would be absorbed. So what they're trying to say here is that if you look at our accounting equation initially, we saw that our assets was equals equity plus liabilities. So initially, we saw that of our financing of 100 million in assets, equity was coming in as 5 million, and then the others were coming in as 95 million there, right? So which basically means if we suffer a loss of 1.8 million, if we suffer a loss of 1.8 million, who's going to absorb the loss? So it means our assets now are going to be equal to 100 million minus 1.8 million. So it would mean we have 100 million minus 1.8 million. Okay, I'm rounding this 1.8 to 1.8, right? So that's consistent with what they're saying in the textbook because they rounded off that figure as well. So it would mean 100 minus 1.8, it would give us 98 98.2. Our assets are now going to be 98.2 million. And our equity, are going to absorb the 1.8 loss, which means our equity is now going to be equal to 5 minus 1.8. So our equity are going to be equal to 3.2 million. And then the liabilities are going to be left untouched at 95 million. So that the 98.2 million is going to be equal to the other side of the equation, which is equal to what? This plus that as well. So in this case, the company is not going to be, or the bank is not going to be having any problems because the equity has been, we have adequate capital available to absorb these losses from the assets. Are we on the same page? Any questions? So here, that's what they're trying to explain on this section where they say equity capital 5% of assets. So after tax loss of 1.8 million, although not welcome, can be absorbed. It would result in a reduction in equity capital to 3.2% of the assets because the equity is now going to be 3.2 million, which is equal to 3.2% of the initial assets. Then even a second bad year, similar to the first, would not totally wipe out the equity. Then if DLC has moved to the more aggressive capital structure shown in table 2.4, it is far less likely to survive. 1 year where the losses are 4% of assets would totally wipe out an equity capital, and the bank would find itself in serious financial difficulties. So it would no doubt try to raise additional equity capital, but it is likely to find that this difficult, which when in such a weak financial position, so it is possible that there would be a run on the bank and the bank would be forced into liquidation. So if all assets could be liquidated for book value, the long-term debt holders would likely receive about 4.2 million rather than 5 million, and the depositors would be repaid in full as well. So which means in the second scenario, remember the second scenario is where we are saying we have depositors worth 94 million and our equity capital is equals to 1 million. So what does that mean? If that is the case, we know our assets is equals to equity plus liabilities. Initially, we have assets worth 100 million is equals to equity, which is now, remember in the second scenario, we saw that if we have less equity and more deposits, we're able to increase our return on equity. But now we're trying to find out exactly, so what happens in the case where we suffer losses as well? So when you suffer losses, what is going to happen? 1 is equals to our equity and liabilities are going to be equals to the other section is going to be 99 there, right? So which means if we suffer a loss of, if we're going to be suffering a loss of minus 1.8 in this case, it would mean this side would be equal to 98.2. And this would mean we are on, the equity is only going to be able to absorb the 1 million, isn't it? So the equity is going to be able to absorb only the 1 million, which means the liability side is the one that has to absorb the other 0.8 million. But now to absorb the other 0.8 million, we now need to check to see exactly what makes up the liabilities. We saw that for the liabilities, we have 94 from depositors, and then the other 5 million coming from the long-term debt financing, isn't it, right? So which means in this case, the long-term debt financing is the one that is going to be left out to absorb this amount, so that we're able to absorb, so that we're able to leave out the depositors safe as well. And the higher the losses, the more you are going to end up affecting the depositors as well. Because if the losses will now end up being too high, like for example, they're saying if the losses are going to be 4 million here, so it basically means if the losses are 4 million, it would mean what's going to happen if we suffer a loss of 4 million, it would also mean here we're going to subtract 4 and we're left with 96 million. And here we're taking out 1 because that's the maximum equity that is available, and we're going to be left with 0, which also means the 5 million, from the 5 million, we're going to take out 3 million there. So which means on this side of the equation, we're going to be left with what? 94 million plus 2 million, which gives us 96 million there. So which means we're going to be having a situation where the long-term debt capital is going to be, or subordinated debt capital is going to be affected as well. And now the risk here is that if this loan or these losses keep going up, you're going to have a situation where this would be wiped out, end up affecting what? The depositors, which is not what the government wants, because the government wants to make sure that what the clients or the customers, they maintain confidence in the country's financial system as well. So are we on the same page on what they're trying to demonstrate when it comes to this particular example? Are we together? Any questions? So going back to our question, going back to the example, so this is why they say they would be able to receive 4.2 million rather than the 5 million that they were initially invested. So this is the case where initially we said for the 1.8 million loss that has been suffered on the asset side, 1 million will be absorbed by the equity capital holders, and then the other 0.8 million is going to be absorbed by the what? Subordinated long-term debt. So which means instead of them getting 5 million, they're getting 0.8 million less, which is equals to the 4.2 million in this case. So clearly, it is inadequate for your bank to have only 1% of assets funded by equity capital. So maintaining equity capital equal to 5% of assets in table 2.2 is what is more reasonable than only 1% of assets. Are we on the same page when it comes to this example? Any questions? So we are going to look at this in detail as well when you look at chapters 15 to 18, because that's when you're going to be looking at the Basel Accord as well when it comes to in relation to the bank. So here they say, as we shall see in chapters 15 to 18, bank regulators have tried to ensure that the capital a bank keeps is sufficient to cover the risks it takes. So the risks include market risk, credit risk, and operational risk. Are we on the same page on section 2.2? Any questions? Anyone lost? On section 2.3, we look at deposit insurance. So here they say, to maintain confidence in banks, government regulators in many countries have introduced guarantee programs. These typically insure depositors against losses up to a certain level. From a South African perspective, the last time I checked, it was still at a proposal phase. I'm not sure exactly if they'd updated it as well, or it was promulgated as well. Because I still remember when you look at, although there was government intervention, if you look at the case of VBS Bank, you will see that there was government intervention because the government wants to maintain confidence in the financial system. But at the same time, I don't think there was depositors insurance when it comes to the banks as well. I don't think that they had it was, but they were. I remember the last time I checked, when you look at the Reserve Bank, what are those proposals? There was a proposal to introduce deposit insurance as well, but I'm not sure if it has been put in effect as well. So are we on the same page when it comes to deposit insurance and how it works? So the main idea behind deposit insurance is mainly because we are trying to protect the depositors when you look at the risk that the banks are taking, so that no matter what happens, even if the bank suffers losses, the depositors are protected as much as possible to maintain confidence in the financial system or the banking system of the economy as well. So in On page 31, they give us just a rough history of deposit insurance from an American perspective, because we don't have that information available from a South African perspective as well. So here they say between 1980 and 1990, bank failures in the US accelerated. And if you skip the next sentence, they say there were several reasons for this. One was the way in which banks managed interest rate risk, and we'll talk about it in chapter 9. So another reason was the reduction in oil and other commodity prices, which led to many loans to oil, gas, and agricultural companies not being repaid. So a further reason for the bank's failure was that the existence of deposit insurance allowed banks to follow risky strategies that would not otherwise be feasible. So for example, they could increase their deposit base by offering high rates of interest to depositors and use the funds to make risky loans. So without deposit insurance, a bank would not follow this strategy because its depositors would see what the bank was doing, decide that the bank was too risky, and withdraw their funds. So with deposit insurance, it can follow the strategy because depositors know that if the worst happens, they are protected by the FDIC, which is basically the deposit insurance corporation there. So they say this is an example of what is known as moral hazard. We will talk about moral hazard further in chapter 3. So it can be defined as the possibility that the existence of insurance changes the behavior of insured party. So the introduction of risk-based deposit insurance premiums has reduced moral hazard to some extent as well, because they are now going to, so it would mean that the more you claim, the higher the premium that you're going to be paying for the deposit insurance as well. So because of that, ideally, they want to cut their costs, so they would try as much as possible to have less claims on the insurance as well. Are we on the same page when it comes to deposit insurance? Any questions? So apart from commercial banks, we also have investment banks. And when you look at investment banking, they say the main activity of investment banking is raising debt and equity financing for corporations or governments. This involves originating the securities, underwriting them, and then placing them with investors. So in a typical arrangement, a corporation approaches an investment bank indicating that it wants to raise a certain amount of financing in the form of debt, equity, or hybrid instruments such as convertible bonds. So the securities are originated complete with legal documentation, itemizing the risks, the rights of the security holders. So a prospectus is created outlining the company's past performance and future prospects. So the risk faced by the company from such things as major losses are included. So there is a roadshow in which the investment bank and senior management from the company attempt to market the securities to large fund managers. So a price for the securities is agreed between the bank and the corporation. So the bank then sells the securities in the market. So there are a number of different types of arrangements between the investment bank and the corporation. So sometimes the finance takes the form of a private placement in which the securities are sold to a small number of large investors, such as life insurance companies, pension funds, and investment bank receives a fee. On the other hand, on other occasions, it takes the form of public offering where securities are offered to the general public. So a public offering may be on a best efforts or firm commitment basis. Please take note of the example that we're going to be looking at, where we look at the fees charged when you follow the best efforts and the firm commitment fee, and also the advantage or disadvantage of each one of them as well. So here they say, in the case of a best efforts offering, public offering, the investment bank does as well as it can to place the securities with investors and is paid a fee that depends on some extent or on its success. In the case of firm commitment public offering, the investment bank agrees to buy the securities from the issuer at a particular price and then attempts to sell them in the market for a slightly higher price. So it makes a profit equal to the difference between the price at which it sells the security and the price at which it pays the issuer. So if for any reason it is unable to sell the securities, it ends up owning them itself. So the difference between the two arrangements is illustrated in example 2.1. So we're going to be looking at the difference between a public offering where we follow the best efforts and the firm commitment basis as well. So can you quickly read through the paragraph that is given, the first paragraph on that example, and we go through together. So there are two types of arrangements that we are looking at in this case: best efforts arrangement and a firm commitment basis as well. So with the best efforts arrangement, they're saying when you look at the fee that the investment bank or the return or the profit that the investment bank is going to be making, we would say their profits to the investment bank is going to be equal to, they are charging a fee of 30 cents per share, and they're going to be issuing 50 million shares. So they're charging 30 cents per share, and they're going to be issuing 50 million shares. So in this case, how much profit is the investment bank going to be making? So the investment bank, in this case, with the best efforts arrangement, the investment bank is going to be making 50 million as a return, isn't it? The next arrangement is the firm commitment. Now, when you look at the firm commitment, they give us two scenarios. So they give us the two scenarios. Remember, they are committing to buy the share of the company for $30, right? So they are committing to buy the share of the company for $30. But now, going into the future, in the first scenario, if the selling price of this share ends up being $32, so if the selling price of this share ends up being $32, it would mean their profit or loss is going to be equal to, they are selling this share in the market for $32. They are committing to buy this share from the company or from the issuer at $30. And they're going to be selling how many shares in the market? 50 million shares in the market. So in this case, how much profit are they going to make? How much profit do they make? So how much profit do they stand to make?
$100.
So they will be standing to make a profit of 100 million, right? In the second scenario, if they're able to sell this share in the market for $29, so it means in the first scenario, they're making a profit of 100 million. So in the second scenario, if they're able to sell the share in the market for only $29, it would mean their profit or loss is going to be equal to $29 minus what they're paying for the share, which is $30, multiplied by 50 million. So how much is the profit or loss that they're going to be making in this case? Minus 1 times 50 is going to be a loss of what? Of 50 million, isn't it? So in this case, they're going to be suffering a loss of 50 million. So do you see that with the best efforts arrangement, no matter what happens in the market, they are guaranteed of 15 million profit or earnings there. But with the firm commitment fee, with the firm commitment arrangement, if the price goes up, they make more profits. But if the price goes down, they suffer losses. So this relationship is being summarized on page 33. So this relationship is being summarized on page 33, where we're saying with the best efforts arrangement, no matter what happens, they're guaranteed a positive return of what? 15 million. But if the share price goes down with the firm commitment arrangement, their profits end up going down to 50 million. They suffer a loss of 50 million. And if the share price goes up, they basically earn a profit of what? Of 100 million. So with the firm commitment arrangement, it's more riskier in the sense that they can either make more money or they suffer losses as well. So please just take note of the calculation of the different profits that the investment bank can be able to earn there. Typical exam question. Are we on the same page? Now, looking at investment banks, we now need to find out exactly how the shares are issued. So if it's an IPO, which is on section 2.4.1, they say when the company wishing to issue shares is not publicly traded, the share issue is known as an initial public offering. So this type of offering is typically made on a best efforts basis. So the correct offering price is difficult to determine and depends on the investment bank's assessment of the company's value. So the bank's best estimate of the market price is its estimate of the company's value divided by the number of shares currently outstanding. However, the bank would typically set the offering price below its best estimate of the market price. This is because it does not want to take the chance that the issue will not sell. Then the other way of issuing the shares would be through what they call the Dutch auction approach. And with the Dutch auction approach, they say a few companies have used a Dutch auction approach for their initial public offering. As for a regular IPO, a prospectus is issued and usually there is a roadshow, and individuals and companies bid by indicating the number of shares they want and the price they are prepared to pay. So shares are first issued to the highest bidder, then to the next highest bidder, and so on, until all the shares have been sold. So the price paid by all successful bidders is the lowest bid that leads to a share allocation. So this is illustrated by example 2.2. Can you quickly read through example 2.2 and we'll go through together? So the company wants to do an IPO to sell 1 million shares. So with the Dutch auction approach, what happens is the party with the highest bid is the one that is allocated the shares. So they get the number of shares depending on exactly how many shares that they indicate that they want. So in this case, if you look at the different bidders, the one with the highest bid in this case is bidder C, with a share price who's offering a share price of what? Who's offering a price of $33. So he's going to be able to get the number of shares that he needs, which is equal to 50,000 shares. Then the next highest bid in this case is 31.5. And 31.5, they are going to be getting 300,000 shares. Now, so far, we have 350,000 shares. The next highest bid in this case is E with the price of $30.50. And they're offering 150 shares. They indicate 150,000 shares. So which means now in total, the number of shares is equal to 500,000 shares. The next highest bid after that is H with a bid price of $30.25. So from 500,000 shares, the number of shares issued now is going to increase to what? By 200,000 shares to 700,000 shares. Then the next highest bid after this is equal to A with a bid price of $30. So the number of shares now in total is going to be equal to 800 shares. So the number of bids is equals to 800 shares. Then from there, the next highest bid in this case is equal to D. And D offered 29 and he indicated that it needs what? 300,000 shares. So now there's only 200,000 shares remaining, and he's indicating that he wants 300,000 shares. So it basically means that instead of getting 300,000 shares, he's only going to be able to get what? The remaining, which is 300,000 shares. So in this case, the bid price, so which means in this case, the market, the price paid by all the investors to whom the shares are allocated is going to be $29, because this is the lowest bid price that has been indicated in this case. So that's basically how it would work with the Dutch auction approach. So here they say, the Dutch auction potentially overcome two of the problems with the traditional IPO that has been mentioned. First, the price that clears the market is $29, should be the market price of all potential investors who have participated in the bidding process. So which means everyone now is going to end up what? Paying $29. And second, the situation where investment banks offer IPOs only for the favored clients is avoided. However, the company does not take advantage of the relationship that investment bankers have developed with large investors that usually enable the investment bankers to sell an IPO very quickly as well. So are we on the same page on how it works when it comes to the Dutch auction approach? Any questions? Any questions? Remember, after all is said and done, the bid price that all these investors who have qualified that they're going to pay So after all is said and done, the bid price that all these investors are going to end up paying is $29. Please make sure that you take note of that as well. So the bid price that all the investors are going to pay is equal to $29. Now, when it comes to investment banks, the other issue that you need to make sure that you take note of is the issue of advisory fees. And yet they say, in addition to assisting companies with new issues of securities, investment banks offer advice to companies on mergers and acquisitions, divestments, major corporate restructuring, and so on. They will assist in finding major partners and takeover targets, or help companies find buyers for divisions or subsidiaries in which they want to divest themselves. They will also advise the management of companies that are themselves major or takeover targets as well. So when you look at the typical advice that they can also give to takeover targets, it's discussed on page 36, where they say sometimes banks suggest that clients should take to avoid a merger or a takeover. This is known as the poison pills. So examples of poison pills are: a potential target adds to its charter a provision where if another company acquires 1/3 of the shares, other shareholders have the right to sell their shares to that company for twice the recent average share price. And the second one is, a potential target grants its key employees stock options that vest in the event of a takeover. So this is liable to create the exodus of key employees immediately after a takeover, leaving an empty shell for the new owner. Then the other one is, a potential target adds to its charter provisions making it impossible for a new owner to get rid of existing directors for 1 or 2 years after an acquisition. And the other one would be, a potential target issues preferred shares that automatically get converted into regular shares when there is a change in control. And the other one would be, a potential target adds a provision where existing shareholders have the right to purchase shares at a discounted price during or after a takeover. And then the last one is, a potential target changes the voting structure so that the shares owned by management have more votes than those owned by others as well. So that's basically typical examples of poison pills. Are there any questions regarding that? So here they say, poison pills, which are illegal in many countries outside the US, have to be approved by a majority of shareholders. Often, shareholders oppose poison pills because they see them as benefiting only management. Next, we look at the securities trading activities of banks. And here they say, banks also get involved in securities trading, providing brokerage services and making a market in individual securities. In doing so, they compete with smaller securities firms that do not offer the same the other banking services as well. So make sure that you take note of that. So here they say, a broker assists in the trading of securities by taking orders from clients and arranging them to be carried out on an exchange. So remember, not everyone has the minimum requirements for them to be able to trade on a particular exchange. Because for you to be able to participate on a particular exchange, there's a minimum requirement that you need to be able to achieve as well. There's a certification that you need to be able to achieve. So if you want to participate on a particular exchange, but you don't have the minimum requirement or certification, that's when you now execute your trades via a broker. So that's basically, so the broker is basically comes in as the middleman. Then on the next paragraph, they say, a market maker facilitates trading by always being prepared to quote a bid and an offer price as well. So a typical example of a market maker is basically what we find when it comes to the bank. When you want foreign currency, you go to the bank, and then they'll tell you exactly how much they're selling you the foreign currency, which is basically the offer price. Then when you have foreign currency and you want to sell your foreign currency, what do? You can also go to the bank, and then the bank will tell you exactly how much they are prepared to pay for the currency, for the foreign currency, which is what we refer to as the bid price. So how the banks make money is now where they say they are selling you foreign currency at the offer price, and then they buy, which is higher, and then they buy foreign currency from you at the bid price, which is lower. So the difference between the bid and offer price is basically how the banks are able to make money as well. On section 2.6, we look at potential conflicts of interest in banking. And here they say there are many potential conflicts of interest between commercial banking, security services, investment banking, when they are all conducted under the same corporate umbrella. So here they say, for example, when asked for advice by an investor, a bank might be tempted to recommend securities that the investment banking part of the organization is trying to sell. So in this case, they say when it has fiduciary accounts, the bank can start difficult to sell securities into that account as well. Then they also say a bank, when it lends money to a company, often obtains a confidential information about the company. It might be tempted to pass that information to the mergers and acquisition arm of the investment bank to help it provide advice to one of its clients on potential takeover opportunities as well. Then they also say the research end of the securities business might be tempted to recommend a company's share as a buy in order to please the company's management and obtain investment banking business as well. Then they also say, suppose a commercial bank no longer wants a loan it has made to a company on its books because of the confidential information it has obtained from the company, leads to it believe that there is an increased chance of bankruptcy. It might be tempted to ask the investment bank to arrange a bond issue for the company, with the process being used to pay off the loan. So this would have the effect of replacing its loan with a loan made by investors who are less well informed. So as a result of this type of conflicts of interest, some countries have in the past attempted to separate commercial banking from investment banking activities of the bank as well. On section 2.7, we look at today's large banks, and yet they say today's large banks operate globally and transact business in many different areas. So they are still engaged in the traditional commercial banking activities of taking deposits, making loans, clearing checks. They offer retail customers credit cards, telephone banking, internet banking, automated teller machines. They provide payroll services to businesses, and also, and as already mentioned, they have large trading activities as well. Now, when you look at the accounting services, they say it is appropriate at this point to provide a brief discussion of how a bank calculates a profit or loss from its many diverse activities. So activities that generate fees, such as most investment banks activities, are straightforward. Accrual accounting rules similar to those that would be used by other businesses apply. For other banking activities, there is an important distinction between the banking book and the trading book. Please, as potential theory questions, please take note of the difference between the banking book and the trading book as well. Very, very important. So they say, as the name implies, the trading book includes all assets and liabilities that the bank has as a result of trading operations. So the values of these assets and liabilities are marked to market daily. So this means that the value of the book is adjusted daily to reflect changes in the market prices. Then the banking book includes loans made to corporations and individuals. So traditionally, they have not been marked to market because they are expected to be held until maturity as well. So please make sure that you take note of the difference between the banking book and the trading book. But although we are going to discuss it again later on between chapters 15 and 18 as well. On sections 2.7.2, they look at the originate distribute model. And yet there is also, they say DLC, the small hypothetical bank we looked at in table 2.2 to 2.4, took deposits and used them to finance loans. So an alternative approach is known as the originate to distribute model. This involves the bank originating but not keeping the loans. So portfolios of loans are packaged into tranches that are then sold to investors. And this is one of the issues that resulted in the credit crisis in the US, where these loans, these mortgage-backed loans, were being repackaged and sold to investors who didn't understand the implications of the underlying assets as well. So on page 42, they say the originate to distribute model is also termed securitization because securities are created from cash flow streams originated by the bank. So it is an attractive model for banks. By securitizing its loans, it gets them off the balance sheet and frees up funds to enable it to make more loans. So it also frees up capital that can be used to cover risks taken elsewhere in the bank. So a bank earns a fee for originating a loan and further fee if it services the loan after it has been sold as well. So please make sure that you take note when it comes to the originate and distribute model, how it works. Are there any questions from unit 2.7? Any questions? So the remaining sections are mostly theory. So I'm just going to go through it. If you still don't understand, please go through it again. And if you are lost, let me know so that I'm able to explain to you in detail. On unit 2.8, we look at the risks facing banks. And on second paragraph, like on the last sentence, they say, capital is now required for 3 types of risks. So if you look at, we're going to look at it in detail when you look at the Basel Accord, how it has developed as well. Because initially, the capital adequacy was focusing more on credit risk. But now, as they've seen over time, credit risk is not the only risk that the capital of the bank needs to account for. So that's why you see that they say capital is now required for 3 types of risks: credit risk, market risk, and operational risk. So here they say credit risk is the risk that the counterparties on loan transactions and derivative transactions will default. So this has traditionally been the greatest risk facing a bank and is usually the one for which the most regulatory capital is required. Market risk arises primarily from the bank's trading operations. So it is the risk relating to the possibility that instruments in the bank's trading book will decline in value. Then operational risk, which is often considered to be the biggest risk facing banks, is the risk that losses are created because internal systems fail to work as they are supposed to, or because of external events. So the time horizon used by regulators for considering losses from credit risk and operational risks is 1 year, whereas the time horizon for considering losses for market risk is usually much shorter. So the objective of regulators is to keep the total capital of a bank sufficiently high that the chance of a bank failure is very low. So please make sure that you take note of this as potential theory questions as well. Then on page 43, they say, in addition to calculating regulatory capital, most large banks have systems in place for calculating what is termed economic capital. So this is the capital that the bank using its own model rather than the prescribed by those prescribed by regulators thinks it needs. So economic capital is often less than the regulatory capital. However, banks have no choice but to maintain their capital above the regulatory capital level. So the form that the capital can take is prescribed by regulators. To avoid having to raise capital at short notice, banks try to keep their capital comfortably above the regulatory minimum. So please take note. Take note of the difference between economic capital and regulated capital. We're going to look at it as well later on in chapters 15 to 18. But the main idea here is that when you look at, remember we said there is a split between when we say our assets is equal to equity plus liabilities. So the capital that they're talking about there is basically this equity component. So when you look at regulated capital, we're basically saying, what is the minimum percentage of your assets should be coming from what? From equity. So what minimum percentage of your assets should be financed by equity? So you find that, remember, we also saw that there's a temptation for the banks to lower the equity capital, because if they lower the equity capital and finance that by what? Issuing more deposits. We saw that there's more risk involved, although there's higher return that they were expected to return as well, right? So it basically means that when it comes to economic capital, in most cases, you would find that economic capital is usually lower than regulatory capital, because the lower the economic capital that the bank needs, the more they're able to be leveraged and the more returns that they're able to be able to get as well. But remember, the higher the risk, the higher the expected return. Then regulatory capital is now that capital that by regulation that's saying this is the minimum capital that you must be maintaining. So what does that mean? It basically means that the moment you see that the economic capital is less than regulatory capital, automatically the capital that you need to maintain in your books should be regulatory capital. You should not have a situation where your economic capital is less than that. You should not have a situation where the capital that you're maintaining in your business is less than the regulatory capital. That's basically what they're trying to explain on this particular section. Are we on the same page there? Any questions? Anyone lost? On the next section, so in the next class, remember we saw that learning unit 2, they ask us to cover chapters 2 to chapter 4. So now we have done chapter 2, where we looked at the banks. Now we are going to be looking at what? Chapter 3. And chapter 3 looks at insurance companies and pension plans. So we need to make sure that we go through this. And I still remember in the Gen-Feb exam, there was a question that students were asking me after the exam where they were saying they were not sure. Yes, we covered it in the class, but they were not sure exactly how we're supposed to cover it, because now it was covering a longer period of time than the period that was given in the example in the class as well. So please, the next class, very, very important. There's a calculation there where you look at mortality tables that you need to know exactly how to do the calculations they were using the mortality tables. So chapter 3, very, very important. Then chapter 4, we look at mutual funds, exchange traded funds, and hedge funds as well. Please take note of that. And remember, when you look at mutual funds, you're basically looking in South Africa, from a South African perspective, we refer to them as unit trusts. So when you look at whenever you see mutual funds in the textbook, just know that they're referring to unit trust type of investments as well. So in the next class, we're going to be looking at chapter 3. I think the next class we are not going to move on and finish chapter 3. We should be we need to make sure that we fully understand and look at a past paper question based on chapter 3 as well, so that you fully understand how these different components work as well. Are there any questions from what we have done when we look at banks? Any questions? Any questions? All right. If there are no questions, enjoy the rest of your weekend. Please try as much as possible to go through the material in advance, so that if there's something that you don't understand, ask questions. So the textbook is available. I'll also try to share the textbook to everyone on the WhatsApp groups. And also, when you're registered, please try to go through the videos as well, because you need the videos for you to be able to know exactly to prepare yourself for the next classes. So, because remember, these videos are based on what we did last year. So please try as much as possible to look at the material in advance. But most importantly, try to attend as many sessions as possible. All right. Enjoy the rest of the weekend.
Thank you. Bye.
Thank you so much. Thank you.